Paying your credit card on time every month, but your balance barely moves. Here is why. On a $5,000 balance, minimum payments alone can take over 20 years to pay off, and it's not your fault. Let's start with a real example because this only makes sense once you see it in a number. Say you owe $5,000 on a credit card at 22% interest, which, by the way, is completely normal. Average credit card APR right now is 20%. Your minimum payment is actually 1 to 3% of your balance. So, let's say it's around $100 a month. Here is the part that shocks people. If you only ever pay that minimum, it can take over 20 years to pay off that $5,000. And by the time you are done, you won't have paid $5,000 in interest. You will have paid more than double your original balance just in interest on a $5,000 debt. Not because you spend more, not because you miss payments, just because of how minimum payments are built. So, why does this happen? It's not a scam, it's just a math working against you. And once you see how, you will never look at your statement the same way again. Every month, your minimum payment gets split into two parts: interest and principal. Interest is the rent you are paying the bank for borrowing the money. Principal is your actual debt, the part that shrinks your balance. Here is the trap. Early on, most of your minimum payment goes toward interest, not principal. Sometimes 70, 80, even 90% of what you pay is just covering interest. Only a tiny silver actually chips away at what you owe. And because minimum payments are usually in a percentage of your balance, as your balance slowly shrinks, your minimum payment shrinks too, which means even less goes toward the principal next month. It's a loop that resets itself to stay small. You are stuck not because you are bad at this. You are stuck because the payment is mathematically designed to move at a pace that keep you paying interest for as long as possible. Now, here is the part that made me actually angry when I first learned it. Credit card companies make more money from people who pay the minimum than from the people who pay in a full. Minimum payments are not set low by accident. They are calculated to be just enough that you stay in a good standing. No late fees, no credit score damage, while keeping you in a debt as long as legally possible. Because every extra month is more interest paid to them. This is not conspiracy theory. It's in their own numbers. Cardholders who carry a balance and pay only minimum are by far the most profitable customer for the credit card companies. So, if you have been feeling like you are failing at this, you are not. You are interacting with a system built to make failing slowly look like doing fine. Okay, so how do you actually get out of this? Not someday, starting with your next payment. Number one, pay above anything the minimum, even $20, and it goes directly to the principal because your minimum already covered this month interest. Every extra dollar attack the actual debt. There is the single best lever you have. Second, know your avalanche versus snowball option. If you have more than one card, pay minimum on all of them. Then throw every extra dollar at the card with the highest interest rate. First, that's called the avalanche method, and it saves you the most money. If you need motivation more than the math, pay off your smallest balance first instead. This is the snowball method. Either beat doing nothing. Number third, call your card issuer and ask for a lower interest rate. This sounds too simple to work, but issuer approve this more often than people think. Especially if you paying on a time, a 22% rate drop to 16% can cut year of pay of time. Fourth, if your balance is large, look into a 0% balance transfer card or a non-profitable credit counseling service. This can pause interest entirely for a period, which means 100% of your payment goes to the principal instead of the 10 to 20% it's going to now. None of this required a huge income changes. They just required redirecting money away from the interest and towards the actual debt, which is the one thing minimum payments are specially designed to not to do. So, to recap, minimum payments are not designed to get you out of the debt fast. They are designed to keep you in a good standing while paying the maximum amount of interest. That's not a personal failure. That's just how the maths work. But now, You know exactly where your money is actually going, and four real ways to flip that math in your favor, starting with your very next payment. If this help you understand your own statement a little better, hit subscribe. I break down exactly this kind of stuff in every video. So see you in the next one.